Hello everyone and welcome back to PFJ. Today we are going to talk about retirement account and taxes. Over the last couple of weeks we have talked about each of these topics individually and we're just going to put them together today. Now we have talked about how retirement accounts are basically a fancy version of investment accounts, and the biggest thing they do is save you on taxes. And then we have talked about how taxes work. So I wanted to take this video to kind of talk about both of them and put both of those things together. We have talked previously about how there are post-tax and pre-tax accounts. In post-tax accounts, you get your salary. This goes into an account. That money grows into that account over a certain period of time, and then you take that money out. Now in this process, you're taxed up here when you put the salary into the account. So as a result, you're not taxed here. Now this is advantageous because you don't have to pay taxes on the growth. And this is fairly simple to do because taxes are paid up front. So when you take the money out, you just enjoy the money. You don't have to mess with taxes, paperwork, any of that stuff. On the other side, we have talked about that these are employer sponsored accounts. If you're self-employed, then you can do them yourself. You just have to do a little bit more paperwork. But they're again simple to do. In this, the money first goes into the account and then you're paid your salary. So as a result, your salary is a tad bit less. So as a result, because your salary is less, you pay less taxes overall. But in this process, to kind of flesh it out completely, at some later period of time, you can take the money out. But in this process, you're taxed here, but you're not taxed here. So as a result, this gets a tad bit more complicated because you have to pay taxes as you take the money out rather than when you put the money in. Now in the past, we've talked about how up here, before you put the money into the account, you have less money. And then over time, you have more money as the account grows. So you'd rather pay taxes on the less money than the more money. In post-tax world, that is what happens. You pay taxes on the less money so that later on you don't have to pay taxes on the more money. But in pre-tax world, the opposite happens. You don't pay taxes up here, but you pay taxes when you have more money. Now, why would somebody want to do this? And that's where we come to taxes with these things. Now, when we talk in the world of pre-tax and taxes, we have to talk about tax brackets or buckets. Link up above if you have not seen the previous video. But the gist is you have buckets. Each bucket only fills up to a certain level, but each bucket is taxed at a different rate. You start with the first bucket. So over here, you fill this up and then you go to the next one, the next one, the next one, the next one. So say this one is at 10%, we'll make this 15%, this will be 20, 25, and then 30%. Now let's say all of these buckets only hold 20K worth of income. So let's say you have 100K in salary. You first fill up this bucket. This only takes 20K, so you put 20K here, you're left with 80K. So the taxes on this, you do 20K times 10% comes to about 2K. Just going to do the math. You guys can follow me at home with your calculator as well. From the 80K, 20K goes in here. So this comes out to 3K. Leftover is 60K. Again, 20K goes here. You're left with 4K because 20,000 times 20% equals $4,000. So from the 60K, when you take out the 20K, you're left with 40K. So again, you put the 20K in this bucket, fill it up completely. 20K times 25% equals 5K. And then when you take out the 20K from the 40K, you're just left with 20K, all of which goes in here. So 20K times 30% equals $6,000. Now, this is how a tax bracket works. So on a $100,000 income, you'll be paying these many taxes. As you realize that the last bucket, you are charged the most amount of money for the same amount of money. Even though each bucket is only $20,000, on the last bucket you pay $6,000 versus in the first bucket you only pay $2,000. So say what happens if you don't have to pay this bucket. So that's where the pre-tax money comes in. Say you have $100,000, but you're putting $20,000 in a pre-tax account. This makes your new income $80K because you don't pay taxes up front. So the money you put in the pre-tax account just straight up goes away from your salary, and then you only pay taxes on the $80K. So if you do this exercise again, the first box, you're going to be putting $20K, so you'll get charged $2,000. So you're left with $60K now. In the second bucket, you again pay $20K, so you get $3K. At this point, you're left with $40K. In the third bucket, you're again putting $20K down because you have enough money. $20K times 20% again means $4,000. Now, when you take away the 40 from the 20, you're left with $20K, all of which goes into this bucket, and then you pay this taxes. Watch that you don't have to pay the $6,000. In the world of taxes, we sometimes assume that in all of our chunks of money, we're going to be paying $2,000, and that is not true. You tax the most amount of money on the last bucket. So it makes a lot of sense not to have that bucket filled at all. So if you can do anything to reduce that last bucket, it's going to save you the most amount of taxes. And that's the beauty of pre-tax retirement accounts. They allow you to lower your salary and lower your taxable income and allow you to not fill that last bucket and save you taxes on the most expensive bucket. Now, you might be like, why would the US government do this? They're gonna ask me to pay those taxes again. And you're right, they are gonna, because as we looked up here, you're not paying taxes here, but you do have to pay taxes when you take the money out. So you might say, why go to the hassle of paying less taxes here when they're just going to recoup the taxes up there? So let's talk about that part of the equation. So let's look at retirement. In retirement, you're going to have the same sort of buckets. They will be progressive as well because the tax structure does not change regardless of your age. We'll just do 4 buckets here. We'll do the same thing. They go from 10% to 15% to 20% to 25%. I'll make a 6th one as well. This is 30%. And we'll say that this, again, only goes to $20,000. So in retirement, let's assume that we only saved in 1 year, and the money we saved was just this $20,000 we put into the pre-tax account. So we just do 1 year saved and what the taxes will be when you retire. Because you're retired, you have no other income. So your whole income is $20K. Now this $20K goes into the first bucket. Hey, it fills it up completely. So you pay taxes on that $20,000. That equals $20,000 times 0.10 or 10%, and this equals $2K. In the previous example, you would have paid $6,000 for that same amount of money. That same $20K, you would have paid $6,000. But here, you only have to pay $2,000. And that's the difference between pre-tax and post-tax. In pre-tax accounts, you're taking away your most expensive buckets and switching them out for the cheapest buckets. And that's why the progressive tax structure helps it tremendously to save for retirement and save real money now rather than saving money later on. So we talked about how a retirement account and taxes work together. We talked about how they're post-tax and then there's pre-tax. Post-tax is fairly simple because you pay taxes up front. Pre-tax gets a little bit more complicated because you pay taxes towards the end of it. Now, the difference between the two accounts is that you have less money early on that becomes more money with time. So ideally, you only want to pay taxes on the little money, which is what post-tax accounts are, but there is a place for pre-tax accounts. Because our taxes are brackets or buckets, the more buckets or brackets you fill, the higher percentage of taxes you have to pay. So if you cannot fill that last bucket or bracket, you can save a lot more money because even though each of these buckets have the same amount of money, you pay from $2,000 to $6,000 for the same amount of money. So if you cannot pay money in the last bucket, you save a tremendous amount of money, and that's what pre-tax accounts allow you to do. They basically reduce your taxable income from, say, 100K to 80K. Now, you do have to pay those taxes later on, but because when you retire, you don't have any income, they get switched out to lower buckets. So over here, you paid $6,000, but in retirement, you would only pay $2,000. And that's why we like pre-tax and post-tax accounts. I hope you guys found this video useful. If you did, please like, share, and subscribe. Have a good one.